My name is Philomena Adokora, and I will be your lovely host for this Saturday morning. Now, a little bit about me before I introduce you all to our lovely facilitator this morning. I am a financial educator, and I've been a financial educator for 2 years. The reason why I stepped into financial literacy is because I noticed within our community, we did not have much representation, and misinformation is also very detrimental when families of immigrant background or firstborn Canadians are trying to develop in this country. But again, like I mentioned, today's call is not about me. So before I even introduce our lovely Sandria to you guys, I want to know in the chat, how are we feeling this lovely Saturday morning? Even though my voice is gone, I'm feeling about a 10. But I want to know, to those who are on the call, what number between 1 to 10 are we feeling this morning? Because we got to make sure that before Sandria takes the opportunity to present to us, that we have energy. Andrew, thank you for that 9. Who else? I want to see high numbers this Saturday morning. You know what? We should be super excited that we had a chance to be alive. God gave us an extra day to be ourselves and be grateful. Thank you, bbpa office and 8. I love that. I need one more number before we move on, guys. Just one more number. I don't count because I gave you guys a 10. Just one more. That's okay. You know what? We had 2. So guys, just really quickly, Sandria is the owner of allgoodsaccounting.com, a company that provides creative alternative accounting and tax solutions that will move you and your business beyond your current boundaries. Now, with a solid foundation in accounting and bookkeeping, she has been able to combine her expert knowledge in accounting, bookkeeping, and taxes to provide startups for services and small business corporations, and last but not least, individuals. So without a further ado, Sandria Goodall, the floor is yours.
Great. Well, thank you for that great introduction. I really appreciate that, Billy. Yeah, well, again, I thank everyone for giving me the space this morning to speak once again. And I'm just hoping that the knowledge that I put forward is beneficial to you. And as we are in this tax season, you know, the idea is for us to get all the benefits we are entitled to. So today we're going to be looking at personal benefits from the point of view of the typical working individual, and you know what's available for us, and see what we can get from the tax system. So I'm about to share my screen. Just give me a moment here. And if you can tell me, Billy, if everyone can see my screen.
Yep, yeah, on my end, I can see.
Okay, perfect. All right, so we're going to be looking at personal tax benefits. Last week, we looked at tax strategies, right? You know, of all the things that we could put forward. So today we'll be looking at what are some personal benefits we could get out of the tax system. So this is a general information about employee income overall. So for those of us who are earning employment income, if an expense is not explicitly mentioned in the Income Tax Act, it is not deductible. So business owners, those of us who own small businesses, corporations, do not have these same restrictions. Meaning that if a business incurs any kind of to earn income, they can deduct it. So that's how limited we are as employees. If it's not recorded in the Income Tax Act, it is not deductible. In certain circumstances or instances, it may be advantageous to arrange your business relationship so that you are an independent contractor rather than an employee in order to maximize the allowable deduction for self-employment. It's something to consider, right? When a client comes to me and they say they have the option to become a subcontractor or remain on payroll, I say to them, be that subcontractor, because I can definitely work with you and have you get those expenses, write off those expenses that you're entitled to. You get more as a subcontractor. Again, if there are any questions I have a raspy voice as well, so please excuse that as well. If there are any questions in the audience, definitely please let me know, and I'll definitely and so as individuals and employees, we have available to us non-taxable benefits. That means they're not included in our income. We get them, and the good news is that not included in our income, so that means we're not taxed on it. If anything included in our income, that means we're taxed on it. This is not really about change, and unless your employer invites you to this or you're familiar with this, and I do encourage those of us who are working for big corporations to inquire. This is called the Employee Life and Health Trust. A lot of us pay into premiums and get that benefit from your health provider. But there's this other one that's called an Employee Life and Health Trust. It is a trust that was established back in after 2009 for employees of one or more employers. So you can have one or more employers. And this plan is paid fully by the employer. And the employer gets to write off this as a business expense. And it's sometimes invited or given to certain employees, but why not ask for it, right? And the only purpose of this trust is the payment to an employee tax-free for benefit. So if you're part of a group sickness or accident insurance plan, a group term life insurance policy, or a private health service plan put out there by your employer, if you incur any of these issues, and you're part of this employee life and health trust, you get paid out of that. A lot of us are familiar with the registered pension plan, and most of us are a part of this, especially if you are employed and working. And if you're employed and working and are not involved in this, it's a great time to speak to your employer about this. A registered pension plan is an employer-based savings plan registered with the Canada Revenue Agency. It's an account where employees and their employers deposit pre-tax income until the employee retires. Contributions to an RPP is tax deductible. This means you won't pay taxes on the money you contribute. The plan is managed by a financial institution chosen by the employer. If you're a participant in an RPP, you can deduct your employee contribution from your income on line 2700 of your return. So if you get your T4, it's on box 20 of your T4. So that is your contribution to this plan. And this plan is obviously there for when you retire. And this plan, you actually see your contribution, I think on line 52 as well. In box 52 as well on your T4, and it shows you the amount you've contributed to the plan. Depending on the plan that you have with your employer, whether your what I mean by plan is retirement plan. There are two types. You have the defined contribution and defined benefit. And there are two different kinds. So the defined benefit is, based on the contributions that are made, it's already allocated how much you're going to get when you retire. Defined contribution based on other qualifiers like your age and how much you contribute to the plan. It gives you a defined contribution, and based on that defined contribution, you are then entitled to whatever that amount entitles you to receive when you retire. But this is a great plan that if you are getting employment income, ask about it, ask to contribute to it, because your employer could contribute to it. But then when you contribute to it, you get that taxable benefit. Now, a lot of us know of this, but they don't use it. I remember when I was working for, what's that company name again? It was in Barrie, and I was working for this company where at the time it was, I'm trying to remember the name, but it slipped me right now. When I remember, and probably I shouldn't even call it out, so we'll leave it at that. They went through a massive, massive layoff. And at the time when everybody went through this massive layoff, they all came, they gave us this package for us to get ourselves familiar with. And inside of that package was the opportunity for us to get some counseling about, what sort of, actions we're going to take next towards employment and things like that. And so this is a great non-taxable benefit to employees, and it's called the Employee Counseling Services. And if you could get this benefit if you're an employee and you want some counseling regarding reemployment, they do have staff and persons that you could speak with, that could possibly help you with your resume, give you some guidance in terms of where you could go to look for jobs, and perhaps help you with, preparing that resume that you will need at this point. If you're an employee and you have some mental, some mental issues, having some difficulties at home, you can also ask for this counseling service as well. And so it's available to you. It's paid for by your employer. They get a deduction for this, so why not use it up? Even if you're going for retirement, some of us are near that age, speaking to someone about, how your money can be transferred to an RRIF or a LIF, a RIF, that's what they call it, or other these and all these other retirement vehicles. You do have those staff available through there. And financial counseling. Okay. So the idea is, the tip would be ask your employer if they offer this benefit. And it can be offered in a group health benefit plan or just to individual employees. Another non-taxable benefit that employees are entitled to, it's called the reasonable allowances for car and travel expenses. And I really like this one because this one, you don't need proof of the usage of car. You don't need to give receipts or anything like that. And when I work with my clients, I kind of work with them in this way when they're working with their employees. And I'll elaborate a little bit more, but let me just read what's here. It says reasonable allowances for car and travel expenses received by employees involved in negotiating contracts for selling property on behalf of the employer. In addition, no mileage logs or proof of business usage of the car allowance are required. And so the rate for 2024, which is the mileage rate for business related driving, allowable automobile allowances are 70 cents per kilometer for the first 5,000 kilometers driven and 64 cents per kilometer driven after that. And of course, if you are claiming travel expenses, which include your reasonable meals, you could claim $23 a meal to a maximum of $69 a day without receipts. Now, the great thing about this benefit is can be used in many ways. Of course, if you're an employee out on the road and you are doing work for the employer, a lot of persons who are in social services, a lot of persons who are involved in sales and other kind of work, you use your car, and you're not reimbursed for any allowance. This allowance is fantastic because you get it as part of your income on your taxes, on your T4, but it's not taxed. And your employer gets to write off this allowance. and claim it as a deductible expense for themselves. Um, you know, why I say I like this one in particular is because, a lot of small businesses, when they start out, um, they don't, obviously have the funds to fully pay, an employee. And so if your employee is somebody that's out of the road, a lot of running around for you, you know, even if they do off work in the office and go out, periodically, I would say set them up, giving them an allowance, allowing them to claim allowance as part of their employment income. And this way, you as an employer get to deduct this allowance, which reduces your tax liability, and they get this income, which you are not paying tax on, tax free. And it puts them in this lower tax bracket. Obviously, they have to earn another, some income, maybe the lowest base level income where they're taxed minimally, which you pay, the least amount, and they themselves pay the least amount, and it works both ways. So what I encourage, in this particular allowance is maximize this benefit, for your employee. Okay, so maximize the non-taxable benefit for the car and travel allowance. Another credit I find very beneficial, and a lot of us don't take advantage of it. Your employers do have it there, especially if you work in a large corporation and you want to perhaps move to the next level, in your career, or even planning to leave the job and go on to something else. They do have what you call the tuition assistance program. And this is where education costs, including tuition, textbook, meals, travel, and accommodation, specifically relating to upgrading or maintaining your employee skills, are non-taxable benefits to you. And a lot of employers, I must say, use this as a retention tool, when they're hiring you, they tell you, okay, you could upgrade your skills here, you can move up the ladder, we offer this benefit to you. Why not take advantage of it? It's a way for you to get your education tax-free. The onus is the employee must be at arm's length to the employer, and the benefit should not be a substitute for the employee's salary. Okay, and the total amount qualifies for the scholarship exemption with on line 130 of your tax return. So it qualifies for the scholarship exemption and will be subtracted from your taxable income. So what tip I encourage you to have is ask your employer about the tuition assistance program and get training to upgrade your skills tax-free. All right, so now, any questions so far that I could answer? Then I'll be moving into the deduction side of things. Again, deductions are great, and I'll be elaborating a little bit more of them. Again, the only deductions permitted are those described or prescribed by the Income Tax Act. Disability support deduction, and they have this one again. If you are or have an impairment, and again, you don't necessarily have to be on the disability tax credit for this one, but if you have some sort of an impairment in physical or mental function, you may be able to deduct this expenses that you paid in the year. So if you incur any expense to go to work, for example, that could be, if you paid someone to help you with your resume, or, maybe traveling costs to work, where you have to get a special, van to take you, or even to upgrade your school or to go to school. Maybe you have to get specific reading tools or things like that. Or if you, did research to receive a grant, any assistance that you incur, any kind of expense you incur, you know, if you're impaired, you could write off these expenses, a deduction. There are a lot of professionals here, and I'm sure a lot of you know this as well, that if you are a member, especially if you're a teacher, if you're a doctor, if you're a lawyer, you do have that membership renewal that you have to do every year. So if this applies to you, that particular due that you have to pay on an annual basis is deductible, and it's something in this status. So it is not something you get reimbursed by the college or wherever, but it's a deduction from your taxes payable. Legal expenses is another one. If you incur legal expenses, which is a right to collect an amount owed to you. So for example, if you incur legal expenses, you know, to get back a certain amount of tax that you believe you were entitled to, then you would be able to include this as a deduction. Okay, so incur to establish a right to collect an amount owed to the taxpayer that would be included in the taxpayer income as employment income. So this is a deduction. Okay. Last week when I was here, I did speak about RSP, and obviously it's still one of those deductions that are that are available. So contributions to any of these plans, which is the registered retirement savings plan or the pool registered pension plan for those self-employed or is not a part of any kind of plan. If you are not a part of any plan and you want to, you know, obviously contribute to an RSP, then you get to contribute to what you call a pool registered pension plan. And obviously, the only drawback with this deduction is that it's taxable when withdrawn. Okay, so that's the only one. The new one that came in this year is called the First Home Savings Account, which is a registered plan to help individuals save for their first home. This is a direct deduction, and contributions to this account are generally deductible and can be used to reduce your taxes. I believe the maximum you could claim within the first year of 2023 is $8,000, and it continues from there. And just to elaborate just a little bit more in that, for this one, to qualify for the First Home Savings Account, you must not have owned a principal residence within the last 12 months and or within the last 4 years. If you know you owned homes prior to 4 years and currently don't, you still qualify for the First Home Savings Account. I encourage those of us who are renting. It's a fantastic way to save money to buy your first home. The maximum you could claim in this account is up to $40,000, tax-free. Another deduction, it's not really spoken about too much. It's between you and your spouse. Your spouse may get some pension, and maybe you're the higher income earning one. And you know, somebody, you know, you get a pension. You could actually transfer that pension to your spouse who perhaps who's in a lower tax bracket than you are. And so it splits it, and then obviously your taxes go down, so it's a deduction for you. And then they too get that benefit where they're also not taxed. Okay, so this is called split pension amount, transferring spouse or common law partner. They deduct the amount on line 21,000 of your return and elect the split pension amount from line 22. So there is a form called a T1032 joint election to split income that one would need to complete in order for this benefit to apply. Okay, another deduction is similar to the employee expenses, but slightly different. It's called the motor vehicle travel expenses. And this one is incurred in the course of employment, where the agreement between you and your employer is that these are paid by you. Okay? And your employer does not reimburse you or pay a non-taxable allowance. Okay, so the allowance is a little different. This one is for motor vehicle expenses. So if you incur fuel and oil, insurance, maintenance and repairs, license, registration fees, capital cost allowance, leasing costs, and interest on loan to purchase the vehicle, these are expenses that you can directly deduct as a deduction under motor vehicle travel expenses. Sales expenses is another one, and this one is incurred by commission employees. Of course, they're negotiating contracts or selling property on behalf of the employer. And while away from the employee site, they were not reimbursed. And so the good thing with commission employees is that you can deduct all your expenses up to the maximum of the commission you earn. So you could, deduct all of that, any of those expenses to earn commission income up to the maximum of the commission that you earn. Tools for a tradesperson, maximum this year. This is with a new thing that occurred this year. You can get up to a maximum of $1,000 in deduction for those who are in the tradesperson profession. Those who are in artistic ventures, if you incur artistic costs during the course of your employment, you are also allowed to deduct those costs as well. The tip for this one is you need to ensure you get a signed employer certificate, which is a Form T-2200, which is a declaration of conditions of employment from your employer. Okay, and they will sign that, and on there they will tell you the kind of motor vehicle expenses you can, deduct. Because sometimes they don't allow you to deduct all of them, but they will tell you on that form, okay, what you can deduct for that. All right. Any questions so far? Okay.
No questions, but I am definitely learning a lot, Sandra. Thank you so much.
Oh, very good. Thank you so much. Okay, you're very welcome. Okay, the next one is home office expenses. And again, this was alerted to in my last presentation, but here I'm going into it just a little bit more and more specific. Most of us are working remote or hybrid, and it's a little different from the business side of expenses that you can deduct, and a lot of us get a little bit confused in terms of, okay, well, yes, I do work from home, and I'm going to claim all of these expenses. No, not exactly. If required on the contract of employment. Now, just before I get into this, I did have a client that came, actually more than one that came to me, and they said, I don't know why my employer is not allowing me to deduct home expenses. I am working from home, and I give them the T-2200, and I ask them to give me the T-2200, and you're not allowing me to. Well, this year that has slightly changed. Yes, people do work from home, but when there's a choice, meaning you're given the choice to work from home, that means on your own choice and your own reason, you're taking that on. And because you have that choice, then you won't be able to claim the home office expenses because it's a choice. Now, if it's under contract, where they're like, it's in your contract that you must work from home, then this is where you're going to be able to claim these home expenses. So it's very important that when you are employed and you are going to be working from home, you want to make sure that it written in your contract so that you could claim these expenses. Okay. And so you could claim things like your rent, your utilities, your maintenance costs. Now, of course, most of us who own homes are thinking, oh, well, yeah, my mortgage, no, mortgage interest is not included in home office expenses. And property tax and insurance can only be claimed by a commission, or if you are a commission salesperson. So again, it's very specific. Property tax and insurance can only be claimed by if you're earning commission and you're working from home. Okay, so you want to bear that in mind. So the key here and the tip to keep in mind is to ensure your employer completes and gives you a form T-2200, which is a declaration of conditions of employment. Okay, and on that it will lay out specifically your home expenses. Okay, unclaimed expenses can be carried forward. So that's the benefit to you. For those of us who are claiming, you could carry it forward, and next year, if your income is low and you weren't able to apply it, you could apply it next year. Something to add, and this is new in the year 2023, is that I know for COVID, individuals would have been able to claim a detailed home expense, and another one called a general one where you could claim up to $400 maximum. So that particular one, where it's the general one, where you could only claim the maximum of $400, that is no longer applicable. It's actually, they have scrapped that. So nobody's allowed to claim that general one anymore. But, and again, if you go back to 2021 and you are claiming, the detailed one, you could claim those on the T-2200S form. Just wanted to put that little nugget in there. Okay. Now we're going to move into refundable versus non-refundable, and explain it a little bit more what those are and give you some examples. Refundable means, which is a refundable tax credit, means that it reduces the amount of tax you have to pay, and any excess tax credit amounts result in a tax refund from the government. So that's what the refundable tax credit does. It's refundable because if you don't have any taxes to pay, you still get a credit on your tax return. So things like the Canada Training Credit, which I'll elaborate on, and I did elaborate the last time, work from home, which is the one I shared about earlier, business expenses as well. The power of business, I must say, is very important. And I'll elaborate a little bit as well in this presentation. Non-refundable tax credits are also great. And what they are is those are credits that are designed to reduce your taxes payable to zero. But you don't get but it does not result in a tax refund. So what it does, say you work, of course you pay taxes. The non-refundable tax credits are those that reduces the taxes payable, especially if you're in those high tax bracket. And so it helps to reduce your taxes payable. Of course, the result is you get a higher refund, but it doesn't directly give you that tax refund like the refundable tax credit. So the tip here is to use all your tax credits and transfer unused credit to the high income earner in your family. Okay, use them all, especially with the non-refundable one. If you don't use them, you lose them. Okay. Right. Let's look into some of these ones. Again, this one is not really popular. Advanced Canada Workers Benefit, Accessibility Tax Credit. This one is something that you get automatically, okay? The Canada Workers Benefit advance payments are not taxable, but must be entered in the tax return of the individual who received them. The amount received in the calendar year will appear in box 10 of RC 210. So some of us get a little surprised and they're like, oh, it's a tax, it's an RC 210. This particular tax, refundable tax credit is if in the previous year you were below a certain threshold of income, it's, then the government gives you this credit. And so this is the credit that you apply from this slip called an RC 210. Okay, not everyone gets it, but when you get it, it's a good thing. Moving and related expenses is also another credit. You will have to apply for this. So a lot of us, who move, we forget that this is something that you could claim. If you move to start or relocate your business, or to start a new job, or to attend full-time studies at a post-secondary institution, not less than 40 kilometers closer than your old home, as to your new location, your moving expenses can be deductible. Okay, so claim them, especially if you're moving and you're moving a little bit further away from work, remember to claim them. So unclaimed moving expenses, so this is a tip. Unclaimed moving expenses can be carried forward for 1 year and deducted against income earned in the new location in the year after you move. Okay, so that's for those of us who incur that one. Another one, refundable tax credit. It's called the Canada Pension Plan Contribution on Self-Employment Income and Other Earnings. Yes, you do get a deduction for Canada Pension Plan when you work, but this one is when you pay extra. So for example, if you have a business and you work and, you have, salaries, expenses, and things like that from your self-employment, the extra Canada Pension Plan that you claim will come back to you as a credit. Okay, so that's the one for that one. And of course, the Canada Training Credit, which is a refundable tax credit intended to help Canadians with the cost of training fees. Again, this was mentioned last week. So as of 2019, an eligible individual can accumulate $250 each year toward their Canada training credit limit. So up to a maximum of $5,000 in a lifetime. So what does that mean? Any kind of education to improve yourself in the professional realm, you can deduct. And the government is giving you this credit up to a maximum of $250 each year, up to a maximum of $5,000. Okay, so the tip is it applies to education taken at any qualified institution. Okay, and I elaborated last week in detail about that one. The Canada Carbon Rebate, formerly known as the Climate Action Incentive Payment. This is a refundable tax credit, and everyone is entitled to it. So for residents, those of us who live in Newfoundland, Prince Edward Island, Saskatchewan, Manitoba, Ontario, like ourselves, Alberta, residents of small and rural communities may be eligible for this supplement if you live outside a census metropolitan area as of December 31st of the tax year. So I don't know if those of us who, do taxes here, there's this little question that comes up on the return, and it asks you, do you live outside of a census metropolitan area? And most of us do. If you do, and if you click yes, you still get some sort of a credit, but this one is for those who live outside that metropolitan credit, metropolitan area. And this is an automatic credit to all Canadians, okay? And it's there as a contribution that, that is made to climate change expenditure. The government has decided to give us this refundable credit. Childcare expenses. Okay, this is a biggie. CRA recognizes that in order to work, parents incur childcare expenses. And so for children under the age of 7, you are entitled to deduct a maximum of $8,000 per childcare expenses and $5,000 for each child 7 to 16 years old. So for children of any age who are eligible to claim the disability tax credit, it is $11,000 per child. Okay, so that's for those children who have that disability portion. They get to claim this, claim up to $11,000. So childcare expenses do not include normal babysitting costs. Okay, so example where you can claim these childcare expenses are caregivers, day nursery schools, day camp, boarding schools, educational institutions providing childcare services. Okay, so the CRA recognizes this, and the tip for this is that the parent or supporting person with the lower income should claim this deduction. And the only time that doesn't happen is when that person who is the lower tax bracket is in school or mental or physically infirm. Then the person who is in the higher tax bracket can claim this credit. Unfortunately, that's how this one is set up. And again, business use of home, very powerful. This is business use of home. So if you have a business, it directly reduces, gives you back money because it is a refundable credit. Again, these ones, sorry, are a little bit different when it comes to home expenses. So rent, mortgage interest, property taxes are included here. Sorry, and of course, home insurance, utility bills, and maintenance costs. Okay, and again, the portion of the deduction is calculated in terms of the amount of space in the home that is dedicated to business use. Okay, so you could see for business how much more you could claim versus working from home expenses. Okay. A tip here that I mentioned a little bit here, and I guess my typing is a little bit off. Have your corporation rent from you. The corporation claims rent expenses and you can reinvest that money into your business. Okay, and again, I could elaborate with that with anybody who needs further information on that, but that's a tip, especially if you have business use of home expenses and being able to write it off as an expense as you do for business home expense, and then reinvest the money back into the business. And I won't go too much into these areas, but these are some claimable business expenses. Inventory is one of them, which of course are the finished goods or the raw materials used in business. Sorry, excuse me, Gavin. Sorry about that. Sorry, I have a cat here that's bothering me. Gavin, can you come and get him, please? Sorry about that. Sorry. Okay, inventory. Inventory includes raw materials, work in progress, and finished goods. If at the end of the year, the value of your inventory declines below cost, you can deduct the loss immediately. So that's something in business that a lot of people don't know. And again, it's a direct deduction Allowable reserves. This is very powerful when it comes to business. If you receive advance deposits for work done for goods to be delivered in the future, you may deduct a reserve to eliminate the amount received from income. A lot of us who are in business don't know that, and definitely want to apply. If you get income in advance, no need to put it in income right away. Deduct the reserve to offset it. And then, you know, when you do the work, then you put back the reserve, which would be the following year. Incorporated employee as an owner of a business, it's a sure way to reduce your taxes and payable, and it would be good to set yourself up as an employee in your business. Okay. Now, I need to go back to that one. The tip behind this one is keep in mind the losses incurred in your business. If you do have those, they can be carried back 3 years and carried forward 20 years. Non-refundable tax credit. If you don't use your non-refundable tax credit, the CRA will not reimburse you. It will be lost for the tax year. Gavin. Yes. Okay. Okay, the non-refundable tax credit. I do apologize for the delay. So one of them is called the basic personal amount. This one, everyone gets. It's a non-refundable tax credit. So for the year 2023, the basic personal amount is $15,000 for taxpayers with net income of $165,430 or less. Majority of us fall into this tax bracket. So, if you fall into this tax bracket, and you make up to $15,000 for the year, that means you don't pay taxes. Okay, and the Ontario basic personal amount is $11,865. Again, if you earn up to that amount, $15,000 in 2023, before, you're not paying any taxes. Spouse, common law partner, or equivalent to spouse. If you claim this amount, that means you supported your spouse or common law partner, and their net income, which is usually on line 23,600 of their return, or the amount that it would be if your spouse or common law partner filed a return, was less than your basic personal amount. So our basic personal amount is $15,000. So if your spouse or common law partner income is less than your basic personal amount, then you get to claim an amount of $2,499 on your return, and this is a non-refundable tax credit. And if your spouse or common law partner was dependent on you because of impairment in physical or mental function, then there's also another credit called the Canada Care benefit, which I'll be looking at in just a few minutes. But again, if you have a spouse that's living with you and their income is below that 15,000 threshold, then you get to claim this credit, which is a non-refundable tax credit. This one is called the Canada Care Giver credit, and you may claim this credit if you support your spouse or common law partner, and in this case, they have a physical or mental impairment. And the amount you could claim is up to $7,999. And this is when, their annual net income is between $8,021 and $26,782. Now, the Canada Caregiver Credit is applicable not only to your spouse, but also if you support an eligible dependent who's 18 years of age or older. an eligible dependent under 18 years of age at the end of the tax year, your or your spouse's or common law partner's children under 18 years of age at the end of the year, or any dependent who's 18 years of age or older, and they're not your spouse or common law partner or eligible dependent, you could actually claim this Canada Caregiver Credit for. Another non-refundable tax credit, this one is applicable for those who are seniors. You could claim this amount if you were 65 years of age or older on December 31st, 2023, and your net income, which is on line 23,600, is less than 98,309, in which most of us are. If your net income is between 42,335 or less, then you could claim 8,396 on your return as a credit. Okay. The tip for the Canada Caregiver Credit is that the dependent does not have to live with you, right? You can still support them, but they don't have to live with you. Okay, so that's the tip. Adoption expense tax credit. This is a non-refundable tax credit. Again, this one is available for those who are adopting or have adopted. So any kind of fees that you pay to your adoption agency that is licensed under the provincial or territorial government, administrative and legal fees, court costs, reasonable living and travel expenses, translation fees required to be paid to a foreign institution, and any other reasonable expenses required, by the licensed adoption agency. All of these can be deducted, okay, which will reduce your taxes payable. The tip for this one is where more than one person is entitled to the adoption tax credit, say, for example, you and your spouse, both individuals can agree to claim a portion of this credit. Okay, so you and your spouse or your partner, you can decide which cost you guys want to claim each, and that way both persons can claim this credit. The disability tax credit is another one. Again, I alerted to this one last week. If you have a severe or prolonged impairment through a physical or mental function that is certified by a doctor, you may be eligible for a non-refundable tax credit of $9,428 for 2023. A supplement of $5,500 is available in addition to the disability amount for a child who is 17 or under at the end of the year. The thing about the supplement is that it can be decreased by the claim for the child care disability supports deduction and medical expenses that exceed the prescribed amount. The tip for this one is if you're eligible for the disability tax credit in past years, and if you did not claim this disability amount, you may claim as far back as up to 10 years. Okay, so the idea is to be sure to file the form T2201 to claim this disability tax credit. So you prepare it, send it to your doctor, have them sign off on it, send it to the CRA, then they could either approve you or deny you, and if approved, you could go back as far as up to 10 years. Tuition tax credit, again, I alerted to this one last week. Again, a powerful one in that as little as $100, if you pay that in tuition fees, you could claim this tax credit, and it's paid to a recognized educational institution for post-secondary courses. Okay, eligibility for this tax credit also includes non-post-secondary courses that are offered by recognized educational institutions that help individuals who are at least 16 years old and older at the end of the year improve their occupational skills. If students do not claim this tuition or education textbook tax credit, then this amount can be transferred up to a maximum of $5,000 to their spouse or common law partner, parent, or grandparent. The tip for this one is that students are entitled to carry forward unused tuition, education, and textbook amounts, right? So you could carry it forward if you're not allowed to or able to transfer it to your spouse or parent at the time. Medical expenses, again, you could claim medical expenses for any 12-month period that ends with the tax year. Charitable donations to registered charities and other qualified donees. You can get 15% of the federal tax for the first 200 of charitable donations and 29% federal tax credit for any remaining amount. The tip for this one is to keep all your medical and donation receipts for tax purposes. And I am going to end it here. I know I did a mouthful of information to everyone, so hopefully the information was beneficial to you and that you learned a lot. So I'm gonna stop right now, stop sharing, and I'm open to questions.
So again, Sandra, thank you so much for breaking down the different tax expenses and benefits that we can use to our advantage. I, for one, always find taxes a little bit difficult, even as a young adult, as myself. But I think that you thoroughly went through every single possible credit or deductible, which was amazing. And I can see in the chat box as well that the others as well can agree and they feel the same. So I really, really want to thank you for that. As Anika feels like the information was extremely informative. Gerald as well, he thanks you for that great information and it was also very informative.